Joining us this morning, Citi Global Chief Economist Nathan Sheets is with us. Nathan, it's good to have you. We've had a day or so to slice and dice CPI, a lot of discussion about shelter away from home and so forth. How does it feed the Fed, I guess, communication over the next few weeks?
Yeah, I think bottom line on this CPI report is that it was a reminder to Jay Powell and his colleagues that, yes, they made some progress on inflation, but that road back to 2% is going to be long and challenging. And they still have some work to do. And as a result of that, I think now the Fed is going to be kind of shifting its discussion from, how high do we need to be and where's the terminal rate, to how long we're going to keep the rate above 5%. And I think ultimately it's going to be a while, and we ought to get used to 5% plus short-term interest rates.
Are you not of the school of thought that shelter, at least, or owner's equivalent rent will follow sort of the more recent data out of Zillow and new rents and so forth? In other words, the notion that shelter will eventually come to play in the next few months?
Yes, absolutely. I would characterize the readings we got on shelter and owner's equivalent rent as somewhat anomalous relative to what I was expecting and what we're seeing more broadly. But even so, I think that there are going to be other surprises. And specifically, I think that this report signaled that non-shelter services component of inflation is still moving forward at a pretty rapid pace. And non-shelter services, notably, is a larger share of core PCE that the Fed watches even more closely. And I think ultimately for the Fed to really make progress and get traction on the shelter and non-shelter inflation, it's going to require a loosening of the labor market. And that kind of brings in this discussion of recession risks.
So is the point, Nathan, that we can't get both? Market can't have its cake and eat it too. It can't get a soft landing with a decline in inflation all the way down to 2%. That doesn't happen?
If something like that happens, it would be unique relative to the past 60 years of U.S. economic history. And this is something that we've looked at very carefully. Over the last 60 years, we identified 5 similar episodes of rapid wage growth and high inflation. And the end game of all 5 of those episodes was a marked rise in the unemployment rate and a recession. So I don't want to say it's absolutely impossible, but it would be historically unprecedented and would require us to answer the thorny question of, is this time really different?
Nathan, how about employment? We're beginning to look at some 2024 forecasts. I've seen some data that suggests maybe we trough in the 50K per month range. Others are saying we average maybe 100K for the last 3 quarters of the year. Where are you? Do we ever get negative on NFP?
In a recession scenario where the unemployment rate is rising meaningfully, then I think we are likely to see some negative numbers. And a recession at some point in 2024 remains my base case. So let me say, yes, I'm not going to be surprised, and it's going to be painful, it's going to be challenging. But I'm not going to be surprised if we see some negative monthly prints on NFP. But as I say that, it will also take a discrete slowing of the economy relative to where we are right now. And the dynamics on how we get from this relatively resilient economy into that slower economy where, you're seeing negative payroll prints, I think that's the big question. And that's one that, quite frankly, I'm struggling with.